Good morning, everyone. As Gina said, my name is Jill Farrell, and I'm from American Century Investments. And let me just first say how thrilled and honored I am to be here and to be representing American Century. And on behalf of everyone at American Century, we're thrilled to be a part of Local 4's retirement plan beginning in January. This is actually my first, I've never been to Gillette Stadium, so this is fascinating. I always thought, I actually flew in from California, but I work at our headquarters in Kansas City. So I think I always thought my first time at Gillette Stadium would be for a Patriots game, but I would much rather be facing you guys than facing Belichick and Brady, although we did okay a few weeks ago. I'm hoping that perhaps we'll meet again in January. So I am going to be spending the next few minutes just talking very briefly about American Century, just to make you familiar with our firm. I'm going to be talking a little bit about the market environment. You're actually going to hear me say some things that are similar to what you just heard from Mike. And normally I don't like to repeat anything that speakers before me talk about, but these concepts are so important and so vital that I think it's important to emphasize them. And then finally, I'm going to talk a little bit about the One Choice portfolios, which, as Gina said, are the target date options that are going to be available to you beginning in January. And I'm also have a table set up in the back of the room. So after I'm done, and I'll be here the remainder of the day, I really encourage you to stop by and ask any questions. I'm happy to answer them. All right, so we will go ahead and get started. This first slide is really just telling you a little bit about American Century. So American Century was founded in 1958. Our 60-year anniversary is actually this Wednesday, Halloween. My 26-year anniversary with the firm is this Friday. So I've been with the organization a very long time, and I'm thrilled to be a member of it. The firm was started by Mr. Jim Stowers and his wife, Virginia. And they started the firm with $100,000, all of it borrowed. And today we manage $172 billion worth of assets. And of that $172 billion, $40 billion of it, which is roughly about a quarter of it, is in asset allocation strategies, which is the type of strategy that I'm going to be talking with you about today. So it's obviously a very significant part of our firm. One thing I also wanted to mention, I mentioned that the headquarters are in Kansas City, but we also have investment management offices in New York, in San Francisco, and offices in London, Hong Kong, and Australia. So it's really a global firm. But the point that I wanted to make that is really unique about our firm and something that we're particularly proud of is really the last bullet point. And you don't have to necessarily be able to read it, but it's called Prosper with a Purpose. And as I said, our firm was founded by a gentleman named Jim Stowers. And he and his wife obviously had a level of financial success that they could never have dreamed. And Mr. Stowers always had a very philanthropic nature to everything that he did. And so he and his wife were looking for a way to really give back to not just the city of Kansas City, but really mankind, to thank them for all of the success that they had had. And so they donated the vast majority of their personal wealth to fund a medical research institute, which is in Kansas City, called the Stowers Institute for Medical Research. It focuses on gene-based diseases like cancer and diabetes, and literally attracts scientists from all over the world. So the way that our ownership structure works, more than 40% of our profits go directly to the Institute. So while I can say that every day the employees of American Century, we come and our focus is on members like you, doing our very best to provide the investment support that you need for a healthy retirement, to know that there's that greater good that we're working toward as well is a really meaningful part of our culture. And it's a great motivator for everyone who works there. As I said, I've been there 26 years, and there's people that have been there quite a bit longer. So I want to also thank Local 4 for the role that you're playing and to help support those philanthropic efforts as well. Okay. So what I'm going to do now is just talk a little bit about and kind of tail off a little bit of what Mike was talking about as well, and just really focus on talking about the marketplace and talking about volatility and diversification, because I think the last week has really been an interesting demonstration of the reality that we're all living in and really have always lived in. So if you look at this chart, you might think this chart represents the last week, but in reality, this chart represents the last 22 years. So these next few slides are going to be demonstrating and talking about volatility, but then also talking about why diversification is so important. So again, this represents the marketplace over the last 22 years. So beginning in 1997 and going through the September of this year. And when you look at these kind of up and downs, you'll see that starting in 97, the first 3 years was up 106%. The next 2.5 years down 49%. The next 5 years up 100%. The next year and a half down 57%. And then this unprecedented bull market that we've had the last 10 years, it's been up 331%. And the point of this is that there are no investments that can absolutely prevent or withstand a significant market downturn. But the idea is you want to be able to buffer those downturns in the market by having a mix of investments. This represents purely the stock market. This is the S&P 500, which is a substitute for the US stock market. So if you were purely in stocks, this would be a very volatile ride to have. I think Mike mentioned about the marketplace in 2008. So if you look at those big dips, if you were somebody that was retiring in 2008, or you were somebody that was retiring in 2002, just by having unfortunate timing, you happen to be retiring right when there's been a significant downturn, and you don't have enough time to make up for that loss. So you want to have a mix of investments that helps to kind of buffer and provide what we call downside protection. Again, nothing can ever completely protect from complete downside, but what we can do is buffer to mediate those losses. Again, this next slide is just, again, demonstrating the fact that stocks are more volatile than bonds over the last 20 years. Again, you can see a real difference between the first half of the chart and the second half of the chart, because again, the second half has been this unprecedented bull market, which is not typical. The first half, so the previous 10 years, is a much more typical market where you see stocks very high and stocks also having big declines, that volatility. So again, by having a mix of investments, it helps to buffer those events. What this chart really demonstrates is the fact that historically the stock market has always been a bumpy ride, high highs and low lows. And so the first couple of bars you see there, the green and the blue, and then the next green and the blue, represent both US stocks and international stocks. So what we see is in an individual year, in the last 30 years, the highest that stocks have ever gone up in 1 year is 37%. And purely coincidentally, also 37% is the biggest decline they've ever had in a single year. Even more dramatically for international stocks, a single year they were up 65%, in a single year they were down 43%. I'm going to skip the middle one for a second and then go over to bonds. We're up 32%, down 2%, T-bills up 14%, and then basically flat. In the middle you see balanced. And for the purposes of this chart, balance means 55% stocks, 35% bonds, and 10% T-bills. So what you see with the balanced is the highs aren't as high, but the lows aren't as low either. So it allows you to have a good amount of growth, but with a more modest loss. And that growth, with having protection on the downside, will build greater growth over time. And since we're in the middle of the World Series, I don't know how many of you stayed up last night. I fell asleep around the 14th inning, so I didn't make it to the end. But I'll use a baseball analogy. The idea would be, over time, if you were to hit singles and doubles, that will build greater growth over time than if you were to have home runs and strikeouts. Again, that's kind of a rough analogy, but that really is the point that I'm trying to make. Having the more modest increase and the more importantly, a much more modest decrease compounds over time to provide you greater growth. And again, it's that power of diversification. You know, and Mike touched on this as well, because this all makes sense, but it's really hard to do because people are impulsive. They see a lot of news they see a lot of news in the press. They see a lot of people reacting. And the reality is people's natural instincts are counter to what good investing principles are. So when things are really high, you hear the market's doing great. You're like, oh my gosh, everything's great. It's growing. I want to be a part of that. I'm going to buy. And then when things are down and people are panicking or they're concerned, they sell. And that's just the absolute opposite thing that one should do. And so again, having to kind of fight those instincts and to not be impulsive, that's why you really need a sound investment strategy so you can try and take as much of the emotion out of it as possible. And the reality too is that people have different risk tolerances. So just as kind of a general reminder, The higher the the higher return potential a fund or a strategy has, the higher risk it's going to have too. So at the top of return and also the top of risk is going to be international stocks, and then small and then large company stocks. Again, stocks are always going to be, regardless of the size and regardless of the type, stocks are going to be more risky than bonds. So small companies tend to be riskier and also have more return potential than large, because small companies tend to have more volatility than larger companies that tend to be more stable. And then, as you see here, bonds and then money markets. So again, it's just kind of a quick reminder of that relationship between risk and return. Okay, I know this page can be really intimidating. All you need to care about is the colors. That's all we're going to talk about is the colors. So these are just all the words on the right are just the definitions of what's in the boxes, and I'll tell you, and you don't even need to pay attention to the numbers. This is really telling the story about diversification being an investor's best friend. Each of those colors represents a different asset class, a different type of investment. So one color is equities, one is bonds, one is big companies, one is small companies, one is foreign, one is domestic, one is commodities. But the point is that different asset classes perform better or worse in different market environments at different times. So each of those, if you look at those blocks kind of vertically, those are all in a different calendar year. So the type of investment, it doesn't even matter which color is which for our purposes of discussion. The ones that did the best are at the top and all the way gradually to the ones at the bottom. If the same asset classes always did the best, or the same asset classes always did the worst, you would see the same color going across like a horizontal stripe, because the same type of investment would always be doing the best, so it would always be at the top. But you don't see that. What you see is a quilt, because you see colors all over the place. And again, you want to own investments that behave differently from one another. You do not want all your investments to be all up, or it would sound really exciting if all your investments were up all at the same time, but I assure you that means they're also going to be all down at the same time as well. So you want to have these investments that behave differently from one another, because they're less likely to perform poorly all at the same time. And what's really actually interesting about this is if you do the math, again, there's 10 different asset classes or types of investments represented. If you divided this by 10 and you took 10% of each of those classes, that mix would actually be the third highest. The third highest performer of the 10 is an equal division between all 10. So that's the third highest return, but with much, much less risk. And again, that speaks to the power of diversification. And diversification isn't just between that's a combination of bonds and stocks. No, bonds, stocks, and money market. It's also breaking down those asset classes as well. So even within stocks, large companies, small companies, domestic companies, international companies, growth funds, value funds. And again, diversification reduces risk because it protects you against that single devastating loss. Remember the slide a few slides ago? Actually, I won't risk trying to go backwards. But when we looked at that one that had kind of the best and worst years, you saw that the worst year for U.S. equities in the last 30 years has been 37% down, and the worst year for international has been 43. But the balanced worst one was 18. So again, it's about mitigating that risk, having that balance. So we've talked a little bit about the market environment, the power of diversification, and the protecting on the downside. And so now I'm going to move on and talk specifically about the one-choice portfolios, which is the American Century target date option that's going to be part of your plan beginning January 2nd. So I'm just going to talk briefly a little bit about what they are, how they're invested, and who would be a potential investor for that type of fund. So put most simply, a target date fund, you kind of see this funnel. It's really just a single mutual fund that diversifies between stocks, bonds, and money market funds. So it's designed to help combat that volatility we've been talking about. And remember, volatility is kind of the up and down of the market, but it's designed to help combat that volatility by diversifying. So, we talked about the fact that different funds respond differently to different market conditions at different times. What this is trying to achieve is to give exposure to those stronger asset classes while reducing the effect of downside in the others. And this is done at American Century by a very experienced portfolio team. At American Century, we have been managing asset allocation investments since 1988, so for 30 years, and have been specifically managing target date investments since 2004. And again, when you hear the term target date, which you hear that thrown around a lot, again, target date just means your target date for retirement. So I think Mike also mentioned the term glide path. And glide path is kind of a fancy way of saying asset allocation. And so the key element of what the investment managers do is to adjust the allocation. And the allocation is the mix of investments. So the allocation just means what proportion are in stocks, what proportion are in bonds, and what proportion are in money market. And what they do is, as one gets closer to retirement, they gradually make the mix more conservative. So the proportion of stocks goes down and the proportion of bonds increase. Does that make sense? Any questions so far? All right. So when we think about who would be a candidate to invest in a target date, these are really kind of the questions that you want to ask yourself. Are you someone that likes to conduct research? Are you someone that likes to select your own funds, follow the markets, do the research, make your own allocations? If you're that type of person, I congratulate you. If you answer yes to most of those questions, then you are more of a do-it-yourselfer. And Mike went over the individual investment options you have. You guys have a great lineup. And for those that like to do that type of research, those are the funds available to you to make those choices. But if you answer no to most of those questions, a target date fund may be an excellent option to help you meet your retirement goals. When we talk about how to select one, it's a really pretty simple formula. You really take your birth year, you add what you determine to be your goal retirement age, and then you land on the target retirement date. So if I were to do this for myself, I was born in 1965, and I'll save you the trouble, I'm 50, I'll save you the trouble of the math, I'm 53. If the retirement age is 65, and I did not win the Powerball or the Mega Millions this week, so 65 is still looking pretty firm, that takes me to 2030. So that would be my target retirement age and my target retirement fund that I would select for myself. As Mike said, and I think Gina mentioned as well, the lineup that you currently have has target date options available, what I would call them on the decades. So we call them vintages. And so as Gina said, for those that are already invested in the target date, those will map over to the corresponding year. So if you're in 2030, you move to 2030, 2040 to 2040, and so on. And then after that, if you would like to move to a 5-year vintage, that will be available to you as well. And if you're someone who's kind of stuck in the middle, like that example where you're kind of between vintages, the decision you can make for yourself is just remember that the closer you are to retirement, the more conservative the allocation gets. So if you're between 2030 and 2035, you know that the 2030 is going to be a little more conservative than the 2035. So if you'd like to be a little more conservative, you can pick the 2030. If you want to be a little more aggressive, then you can pick the 2035. And you can see there the allocation differences for each vintage and how it gradually becomes more conservative over time. Oops, thought I had one more page.
Need to go back?
No, I'm good, sorry. Oh yeah, I am missing it. No, I thought I was. Oh, that's okay, it's all good. So I just wanted to, again, just follow up and reiterate the fact that the target date investment is a single fund with a diversified mix of investments that is maintained and adjusted over time, the allocation with investment professionals, and can be a great alternative for your retirement plan. So I've spent the last few minutes just talking a little bit about American Century, the market environment, the power of diversification to protect for downside risk, and then a little bit about one-choice portfolios. As I said, I have a table set up in the back. I am happy to answer any questions you have, so I encourage you to stop by. And again, I just want to thank you for the opportunity not only to be here today, but to be a part of your organization. We are thrilled and honored to support Local 4 in any way you can. Thank you so much.